Short selling is the practice of selling borrowed securities, such as stocks, in the hopes of profiting by purchasing them back at a lower price than the selling price. In essence, when one sells short a stock, they're hoping to profit from a price drop rather than a rise. A short seller must first borrow a stock before selling it to another investor. The short seller anticipates a price drop over time, where they get an opportunity to buy back the stock at a lower price than the original sale price. After buying back the stock, any surplus money becomes a profit to the short seller. When an investor wants to short sell a stock, a broker will lend it to them from the brokerage's own inventory, another customer of the company, or another brokerage firm. The stocks are sold, and the funds are deposited into their bank account. They must eventually close the short by purchasing the equivalent amount of shares, covering, and returning them to their broker. If the price falls, the investor repurchases the shares at a lower cost and benefit from the difference. If the stock price rises, they repurchase it at a higher price, leading to a loss. The short seller must typically pay a fee to borrow the stocks, equivalent to an interest payment, and reimburse the lender for any cash returns, such as dividends, due during the lease period. To qualify for a loan of shares, one must first be accepted for margin trading, which is a simple process with most brokerage firms. The margin is the security deposit made with a broker as collateral for the loaned stock shares. The investor must have sufficient funds in their stock trading account to cover the desired margin. Margin requirements vary per broker. The short seller's profit is the difference between their buy and sell prices, not the wholesale value. They profit to the extent that your buy price is less than your sell price. Buying long is the opposite of selling short. The distinction is in which direction the stock price is anticipated to trend. If the stock is expected to rise in price, one can buy long, hoping to benefit from the rise. If the stock is expected to fall in price, then one may sell short to benefit from the drop. Other distinctions with short trades include the fact that the broker should always be paid interest on the loaned shares. Naturally, the longer one borrows the shares, that is, the longer one retains their short sell position, the higher the interest rate. Investors may sell short in the expectation of profiting from an overvalued asset, just as long investors or speculators expect to profit from a rise in the price of an underpriced instrument. As an active investing approach, only a few competent money managers use shorting. The vast majority of investors utilize shorts to hedge their positions. Hedging is frequently used to reduce the risk associated with a more complex set of transactions. This implies they are insuring other long positions with short positions. Short selling can be a profitable endeavor, but it is extremely risky. Shorting a stock can result in endless losses and limited reward potential, as opposed to buying a stock, which can result in unlimited profits and limited risk, i.e., you can only lose what you invested. This means that if an investor shorts a stock and the price falls, he or she will only keep the earnings less the current price. However, if the stock price rises, it is impossible to predict how much money the investor will lose because they will have to acquire the shares several times their initial investment. In 2020, a lot of investors believed that Tesla, an electric vehicle manufacturer, was overvalued and shorted the stock. Their prediction was incorrect, and Tesla's stock increased by 700%, causing the short sellers to lose $40.1 billion. A certain stock may become hard to borrow. A broker may levy a hard-to-borrow fee on any day that a regulatory authority says a share is hard to borrow, without notice. A broker may also be obliged to cover a short seller's position at any time, buy-in. The broker issues a notice to the short seller that he is failing to deliver stock, prompting the buy-in. Because short sellers must eventually deliver the shorted assets to their broker and require funds to do so, the broker faces credit risk. The broker needs the short seller to maintain a margin account and charges interest to manage its own risk. According to financial academics at Duke University, short interest is an indication of bad future stock performance, and short sellers take advantage of market misconceptions regarding companies' fundamentals. Some research has shown that banning short selling is counterproductive and has a detrimental impact on markets. Nonetheless, Short selling is subject to serious criticism and is frequently met with hostility from society and policymakers. Short sellers continue the practice and argue that the activity is an important part of the price discovery mechanism.